And again, good morning, everyone, and thank you, and welcome to the Messer Financial Weekly Webinar. Hopefully today, again, we are going to be able to bring information to you as agents that will help you become more proficient in your business. Today we have with us Mr. Chad Kniss. Chad is the Regional Director for the Oxford Life Company, and he's going to work with you today, giving you some examples of cases that you could easily come into in your business life. Also today, I'm going to ask that you stay with us until the very end. I'm going to bring to your attention, if you haven't heard, information on the program we are calling the All In with Messer. Today, again, as always, we'll go through the presentation. We'll save your questions until the very end. And with that in mind, good morning, Chad, and thank you for being here with us today.
You bet. All right. Thanks a lot, Mark. Appreciate it, and appreciate Messer Financial for, the opportunity to join in. With that, I'll go ahead and I think get started. I think everyone already has my screen and is probably looking at the Oxford Life website at the moment. That's nice and easy to get to. It's oxfordlife.com. So today I figured we'd kind of use that as a bit of a tool we'll circle back to as we talk a little bit about Oxford Life. We talk about some of our products, but as Mark mentioned, talk about some kind of case planning that involve Oxford Life products and some kind of real life scenarios. So with the time available, would like to introduce and maybe reintroduce everyone to Oxford Life. Last week we did a webinar where we talked about more just kind of basic information of life insurance, the various forms of life insurance, some of the products available from Oxford Life. Today we want to kind of go into that next step, some of the Oxford Life products specifically, and how you might use those in again, real life planning scenarios. First off, I am going to pivot over. Want to take the opportunity just to kind of update everyone with some of the Oxford Life history. We are A-. That's an excellent rating with AM Best. And we are in really three markets, three spaces, all kind of senior oriented. Life insurance, which is our single premium life product, our final expense product, and we also offer annuities, multi-year guarantee annuities, as well as fixed index products and Medicare supplement. The one, I think one of many great things about Oxford Life, if you've appointed with us for one of those products, you get access to everything that we do. So let's say that you've liked and you've used our final expense product in the past, you're already appointed to us, you can write the MedSup, you can write the fixed index, the fixed annuities, assuming your licensing is appropriate for that. But all of our products just have a standard life and health license. We don't offer any securities or any kind of variable products that would require additional contracting from the security side. Oxford, we were founded in Arizona, Phoenix, Arizona in 1965, and we still remain based and domiciled there today. So Oxford Life, we're about $2.5 billion in total assets. So certainly not one of the bigger carriers out there, but a really great financial story for you and for your clients. We're a really cash-rich company. We're actually owned by U-Haul. It's kind of one of our fun facts, but out on the front of the street in Phoenix, Arizona, you'll find two big U-Haul towers. Oxford Life operates in a building just behind it. So we are kind of their subsidiary, their sister company, if you will. But a lot of people always find that of value as it brings a little bit of a brick and mortar feel to Oxford Life. Maybe you or maybe your clients don't know us, but again, I'd be willing to bet they know U-Haul. 90+% of America does. They've rented one of the trucks, they've seen it rolling down the side of the street, or maybe one of the storage units on the side of the road. So it does have a lot of benefit, I think, to us, the brand recognition. And again, just a lot of the shared services permit us to put as much as we possibly can back into our product. And I think you'll find that time in, time out. We really do try and offer the best rates, whether it's life, final expense, or our MedSup line. So before we kind of roll into some of the case scenarios, I wanted to just kind of lay out what we offer and how some of these products are going to kind of tie into the case examples that we'll discuss. So I've already kind of mentioned Oxford Life. We do life products, final expense and single premium life. We have Assurance. That's our traditional final expense product. That's kind of your pay-as-you-go. We do issue ages on that product 50 to 85. We do amounts from 5 up to 30,000. So again, this is your traditional kind of final expense option. Assurance One we consider also a final expense product, but it's a single premium design. So just as the name indicates, Assurance one time, one lump sum payment, and its issue ages are similar, 50 to 85. Its amounts also the same, 5 up to 30,000, but again, single premium funded. Now, a lot of times when we bring this product up, people think, gosh, it's tough to get final expense clients that can afford monthly payments, let alone lump sum. Where you want to think of Assurance One, and I will tell you right now that where we see just tons of opportunity, and we see a lot of business on this, but Assurance One is really most often used for kind of rescue scenarios. And I'll give you a quick example here. But we see, and I'm sure you do too, so many times a client has an old UL, or maybe dig further into that case, right? They tell you they've already got insurance. Well, tell me about it. What have you got? A lot of times you'll find it's term that's getting ready to expire, or just as commonly in a lot of cases, we find clients that have an old UL, but the illustrated rates for it just can't keep pace. So the client's forced to pay additional premium. It's eating away at some of the cash value in the contract until eventually the policy just kind of blows up on the client. So Assurance One has been kind of coined our rescue product because you can visit with that client. They've got $3,000, $4,000, $5,000 worth of cash value in this old UL, don't want to pay or maybe can't afford future premiums. You can take that cash value, you can do a 1035, which again is that tax-free exchange from that policy into an Assurance One for a paid-up final expense option. So it really is quite simple. It really is kind of a lifesaver in a sense to some of those policies out there. And like all of our policies, it's a true point of sale decision. You're going to know right then and there with the client whether or not they've been approved. The same would apply for Prosperity Select. This is more of our wealth transfer. It's also a single premium, but meant for kind of larger cases. It goes from 30,000 face amount and up. Its issue ages vary just a bit. It's 55 to 80. But with this product, you've got one of the best death benefits out there on a single premium whole life product. It also has a return of premium, so a client can get their money back at any point in time. It comes with a few other features like long-term care, nursing home, and terminal illness riders, accelerated benefits where they can access cash as well. All of these products, and I'll just hit it one more time, but they share our point of sale decision. It's called InstaWrite. And with InstaWrite, we basically can give you and your client an underwriting decision in a matter of minutes, really seconds. You do a phone call to us after they've answered no to the application questions, the health questions on our app. That's kind of our underwriting guide, if you will. But assuming they can answer no to those questions, we will look to either do a phone call, or you can take them straight to our website where we'll do a prescription history on your client and give you that immediate decision. In some cases, it takes us, again, 10 to 15 seconds to run that prescription history and have the decision for you. So again, it is true point of sale decision. There's no additional underwriting that takes place in our home office. Once it's been confirmed, you and your client are both good to go. Just get us the application and we'll have it issued from there. So that's a little bit of the life lineup. Again, final expense and some single premium options. We do annuities as well. Multi-year guarantee annuities. This is kind of your CD alternative. This is just your guaranteed fixed rate options. And we do durations 3 through 10 years. So you can go as short as a 3-year fixed rate up to 10. The rates vary just depending upon the duration. The longer, well, we're in a little bit of a strange interest rate environment, but historically, the longer you go in duration, the better the rate's going to be. That pretty much holds true with Oxford and our product. So you can go as short as a 3-year fixed rate at 2.65, with rates as high as 3.55 into some of the longer durations. But again, this is kind of your CD alternative. It's clients that just want guaranteed growth, maybe some interest options and access to the funds along the way. We offer fixed indexed annuities. There's 3 of them, or kind of 3 series. There's our Royal Select, Silver Select, and Select series. Pretty unique here in the industry. Once again, for Oxford Life, we have as short as a 3-year fixed indexed annuity. Most probably start at 5. The average is a 10-year product, but again, you can go all the way from a 3 up to a 10-year fixed indexed annuity with us, whatever's right for you and your client. We have products with as big as 8% bonuses on a 10-year product, so that's an immediate bonus to your client, which does help supercharge kind of the income, which we'll look at here in just a minute. And mention it, but they do have income riders. All of our products, even our multi-year guarantee annuity, has an income rider that you can attach to it for lifetime income. And our caps are really among some of the best out there as far as crediting, accumulation opportunities. The caps will outpace just about everyone in the market. So whether you're looking to us for accumulation, guaranteed growth, or income scenarios, our annuity lineup can, honestly say is one of the better best out there, especially from an A-rated carrier. We do also offer MedSup. In the majority of states, I will say here we're a little bit more limited, but North Carolina, South Carolina areas we're quite competitive with our Plan G. Just be sure to check us out as you're quoting, how we stack up, where we look, where we fit in there. We're looking to become a little bit more competitive. We had been in the past years, kind of getting back into our groove, finding our space. We're zip code based, so in a lot of areas we'll look good. Some areas, admittedly, we won't, but we'll just ask that you check us out for your MedSup opportunities as well. We do have an e-application. Our MedSup can be sold and done over the phone, unlike some of our other products. And again, with our MedSup, it is also that same point of sale decision. Client answers questions. We can do a phone call and give you that immediate approval right then and there on the spot. So let's jump into some case examples, how some of those products that we just looked at might fit a typical client scenario. And these are some typical client scenarios. Matter of fact, we didn't put names or anything like that, but some of this information was pulled directly from one of our suitability forms on some cases that we've recently worked. So we start out with a client. We just call them Client A, but it's a 73 male, 72 female, and they're both in relatively good health. And they have $507,000 in total assets. Now, out of this, it's kind of mixed around a bit, but $425,000 is in a brokerage account. They've got about $55,000 in some CDs, and then just some various other accounts, savings, some checking, things like that. Their income consists primarily of pension and Social Security. Their biggest concerns, they've stated to you, let's say as the agent, it's outliving income. They're also scared about the market. They're heavily allocated to the market, $425,000 in a brokerage account, so they're concerned about market risk, and like most clients in their 70s, they're concerned about their health. They'd like to travel more, and they'd like to leave a little something for the kids. Considerations, kind of right out of the gate, we think, well, annuity, multi-year guarantee, maybe some fixed index, single premium life. Really, for a client that I think we'd consider more affluent, kind of the whole lineup of Oxford Life really is available to them from a planning scenario. Now, with this first client, we want to dig a little bit deeper, and I want to show you kind of a tool that we've got available for it. I say tool. It's really just a kind of a fact finder, but we've been using this for years, and it started out kind of with our final expense product. It kind of morphed into being picked up and used by a lot of our annuity agents as well, because what you've got, it's just a real simple fact finder, but sometimes simpler is better. You know, a lot of you out there might use your own version of a fact finder. You can find various versions of them online or through other carriers. You know, sometimes they're 4 or 5 pages deep, and you try and get through that with a client, and it feels a bit like an interrogation. So with this, we ask a few real basic questions, but we found, and we've been told, and the reason this is kind of a successful piece, the fewer questions sometimes you ask, the more the client wants to volunteer. So we'll kind of run through an example, and this is kind of that same client example from earlier, just putting in some of their income scenarios. So let's get client A. I'm just going to call them Tom and Judy, but let's say Tom has his Social Security income. It's $23.50 a month. He has an additional life pension. It's a life-only pension. He worked at the telephone company for years, and he has $1,500 a month in a life payout. Judy has her own $1,275 in Social Security, another $600 in pension. So the two of them combined, we've got about $5,700 in income. Pretty nice, pretty healthy income between the two of them, along with some nice assets kind of growing and standing there behind them as well. But now, before I hit the next button, the popular question is, all right, Tom and Judy, they're doing well. Healthy income, some assets, but what happens if, or what do you have to lose if, Tom passes away? So tomorrow, Judy wakes up, Tom doesn't. Most clients are not aware of this, but more than likely, Judy is going to inherit Tom's Social Security payment, which means she loses her $1,275. Tom had his own $1,500, but that was a life-only pension. So as goes his life, so does the pension. So that's another $1,500 in lost income. So just in a matter of a day's time, they've lost $2,700 of income. And that means that Judy, now with her $23.50, the $600, she's got a still very healthy income of $29.50. But how many of us can afford to cut our income almost in half in a day's time? And what you'll most commonly get right here is Tom or somebody saying, yeah, but it's just one of us, right? We can get by on half the income. Depending upon where they're at and some of their planning, that's just not realistic. And we're looking to try and put together a couple pieces that debunk that myth, because if they still carry a mortgage, Judy doesn't call up the mortgage company and say, hey, Tom passed away, can you cut that bill in half? Electric bill, grocery bill, maybe some things go down, but just as often other things go up. Their kids moved away years ago, and maybe Tom was the one that was taking care of stuff around the house, cutting the grass, shoveling the snow in the winter, whatever it might be. And now what does Judy do? She hires out for it. So additional expenses, additional costs. So it's not realistic to think that just because one person has passed away that you can get by on about half the income. So again, that's just kind of a nice scenario to remind clients and also show you how the fact finder might be put to use, because one, it's going to shock clients. A lot of them aren't aware of what happens when someone passes away, what they have the potential to lose. But also, as we go through this scenario, we've heard this again time and time again, but clients start to volunteer additional information. Well, we didn't tell you about the additional life insurance that we've got. Okay, well, tell me about it. Or, we didn't tell you about this other annuity that we have. Okay, tell me about it. But now you're kind of digging into more of the specifics after you've kind of uh-oh'd them with what might happen. So that's where, again, now they're volunteering just more of the assets, more of their total financial picture for you to kind of really get a snapshot for. So let's move on and talk about some planning scenarios and some things we might be able to do for kind of with Tom and Judy. So with them, I'm going to kind of pivot back and forth here with our website, but I do also want to say, and kind of the disclaimer here, this is just one scenario. I'm sure of many. You can look at this case and have different ideas for it, different ways that you'd want to approach it. This is a fairly, we feel, affluent client, but at the same time doesn't seem like it needs a heavy dose of estate planning. But you might get involved with elder law attorney for additional planning, all kinds of different scenarios. This is, again, just one of them. So what we said and what the agent kind of worked with and did in this case. So the client mentioned, again, safety of principal was a concern. So they've got $425,000 in a brokerage account. We wanted to take and carve out some of that to allocate and put into a fixed indexed annuity. As we know, the biggest and best benefits of a fixed indexed annuity are the upside potential of the market, but the downside protection. So immediately we took away some of that risk. $425,000 in a brokerage account. We allocated $300,000 to one of our fixed indexed annuities. And there again, you can kind of get the right feel, which duration is right for you, what do you want with it. We just took and we looked to allocate this to our 10-year select annuity. It has some of the best caps in the industry right now, so a client has the potential to earn up to 6.3% each and every year on a point-to-point basis. So again, $300,000 growing, accumulating with the potential for a 6.3 cap, but still protecting from any downside risk. That $300,000 is protected. If the S&P goes south, the client loses nothing. So market exposure, risk, check. We're still going to allocate and leave some of it in the brokerage account, a little bit more accumulation. Tom likes kind of following the market, so great. We're going to leave a percentage of it there, let it roll. They can afford and able to risk a percentage of that, right? So $63,000 stays inside of the brokerage account. Now, this happened to be a non-qualified account, so we're going to take, and they mentioned that they wanted to leave something to the kids. So we're going to take a percentage of that total asset from the brokerage account. We're going to allocate it to our single premium life product. They mentioned they're in relatively good health, and there's no time like the present to buy life insurance. And as we know, there is no better product to pass on wealth to a beneficiary like life insurance. So we want to go ahead and get them involved, get them engaged with something right now at their current ages and while they're in relatively good health. So what we did, and considering they have the means for it, we carved out $62,000 to put into our Prosperity Select. That's our wealth transfer product. It's an immediate point of sale decision, and $62,000 allocated to it bought them $100,000 worth of death benefit. So again, that is return of premium. They have access to the funds that they needed if they want it, But again, it's an immediate death benefit to the kids, $50,000 apiece, right? That's kind of how we came up with the number. We asked the clients, what do you want to do? $50,000 each to the kids, the two boys. That's great. So there we go, tax-free death benefit passed on to the beneficiaries. So safety of principal, we've given them some income protection and death benefit for the children. Now, I'm going to pivot back over to the website. Whenever I say, and in this first case, we're going to take a little bit more time with it. There's a little bit more planning involved with it. So I'm going to pull everybody back over to our website, and I just want to show you a few of the things that I'm kind of talking about. So you can see here at oxfordlife.com, I'm going to do all of this without logging into the website. So I go up here and I click on the agent button, and I can log in if I want. I don't need to. Here I can access the current rates for the annuities. Here I'm going to go to the calculators. So I'm going to first start off with the indexed annuity. We don't illustrate performance on the indexed annuity, but again, we can show and share the fact that we've got a 6.3% cap, and the client can make up to that much each year with still principal protection. What we can illustrate on our fixed indexed annuities, it's the income. So I'm going to kind of pull back into the one scenario that we talked about with the client. If you remember, we looked at their income scenario and what happens if Tom were to pass away. Judy has a healthy income of $2,950, but again, will she need more? Yeah, she might. Just to say, hey, we went from $5,700 to $2,900 in a day's time. We want to give her income option. So, as an example, our Select series, it's a 10-year fixed annuity with some of the best caps in the market. So what we're going to say here is valued client. Our clients are 67 years of age. Let's just say we're going to do a joint payout. Matter of fact, let's don't. I think we did joint payout on this, but our product's pretty flexible. If one of the client passes away, it allows you to put the other client into the income. So, long story short, we still have plenty of flexibility here with both the husband and wife named as the joint owners to the policy. So, we're going to have one of them as the annuitant on this case. We said we were going to allocate $300,000 into the fixed indexed annuity. We went with the 10-year term, and we now are going to take a look at how this stacks up from an income standpoint. Our income rider rolls up at 6.75%. There is a cost for it, so maybe not everybody wants it. Maybe they just want to accumulate, but they also want the possibility for income potential here. So what they did, they elected an income rider, because if Tom does pass away, it's going to allow Judy to be able to trigger this product for income potential. So this has a scenario where $300,000 is in the index, accumulating, growing based on index type return. And then we have the income rider that's rolling up at 6.75% each and every year. So let's say it's 4 years down the road. Judy's now 71 years of age. Tom just passed away. She can do one of a couple things. She could take the contract value from this an annuity if she wanted to, or she could turn it on for an income stream. If she decided to turn this on for an income stream, you can see here $20,000 approximately in a lifetime income scenario means that on a monthly basis, she can pull $1,600, a little more than $1,600 in income from this scenario. So again, we've just given it that extra flexibility, right? We protected the $300,000 from market risk. We've given it income scenarios by attaching an income rider that lets them come back to the policy, trigger it, and turn it on for income in any of these income scenarios anytime after the first contract year. So just another way to kind of think of that and look at some of the potential of the product. The Prosperity Select, that's our single premium life product. So what we did here is we went in and we assumed that we were going to look at Judy as the client for this one. So she's 72 female, so we used her, assuming that she'll, as things go, Tom will probably predecease her. But also, as a 72-year-old female, we can maximize death benefit. So what we did, let's see here, I'll just use Arizona as an example. We wanted $100,000 of death benefit, and we wanted Judy as the insured. So we just simply put the $100,000 in, we calculate it, and here you can see that $62,000 of premium. So this will give you the full illustration if you want it. Lets you print it, hand it out, walk it through it with the client. But just as kind of nice, it lets you do the quick summary with the client as well. So you can see here the policy does accumulate some cash value over time, but we wanted this primarily for the death benefit, that $100,000 that we want to pass on to the beneficiaries. So it lets us play around with some of the different scenarios and how we're going to get there. Let's say they wanted $150,000, $75,000 each to the kids. Well, just plug it in. You can see here we're going to need to allocate $93,000 to it in order to get there. So it just lets you kind of play around with some of these figures, and also what's right, what your clients want to do. They want to, so less amount to the kids, whatever. It's just kind of massaging some of those numbers to get to where they're comfortable and what works for them. And again, that's just looking at some of the calculators that we have available here for you on the website. So that's just kind of one look at a client scenario. We've got one more. It's client B. It's a 67-year-old male and female. They do have a few health conditions. They have $218,000 in assets. This is made up of some CDs and a 401k. And I'm sorry, on that previous client, I forgot to tell you. What we also did, we looked at, they had $55,000 in CDs, and it doesn't mean we need to, but we also could look to replace that CD. Their CD was earning like 1.3, I think, or something like that. So we could also take and 1035 that, or exchange, I should say, transfer that CD into one of our annuities with another guaranteed rate. So really almost every product fit this client. The ability to wrap in our MIGA, the fixed indexed annuity, the single premium life, maybe even some final expense and a MedSup opportunity. So let's jump ahead to client number 2B. Client B, it's a 67-year-old male and female. They do have a couple of health conditions. This client had a heart attack about 5 years ago. They've got $218,000 in assets, CDs, and some 401k. They're just retiring. So Social Security income is going to be their primary income. $12.59 is current Social Security expectation or income that they're going to draw. So their biggest concern is the income shortfall. So what we're looking at with this client, where we kind of immediately think it's like, well, maybe again fixed indexed annuity with income rider, and this one we might need to draw more immediate income. Of course, I think in most client scenarios, our final expense and MedSup are just kind of the ancillary or additional products, if you will, always kind of in the back of our mind for opportunities if the client can afford it. So what we did with this client is to take $135,000. We allocated that to our Royal Select. They told us they needed about another $400 to $500 of income each year, in addition to the Social Security that they have. So what we did, and I think like everything, a lot of times annuities get bad rap because people try and oversell. You see $218,000 and it doesn't mean everything needs to go to the annuity, nor should it. We want to leave some liquid assets for the client should they need to be able to get access to it, anything like that. So what we did is take, again, out of the $218,000 that they have in CD and 401k, we're going to allocate $135,000 to our fixed indexed annuity, and there's a reason why we went with that amount. But that means we leave about $83,000 liquid in maybe 401k. They've allocated it to a brokerage, leave it in the CD, or again, maybe opportunities to better that CD rate with one of our multi-year guarantee annuity products. But we primarily, and first off, wanted to look to our fixed index product for the income shortfall. So I'm going to pivot real quick back over to the Oxford Life website. I'm going to jump back into our calculator, and I'm going to go back in here to our GLWB. This lets us illustrate income for the client. With this one, I want to use the Royal Select. This is our 10-year fixed indexed annuity, but this is the version that comes with the 8% bonus. It is the best income opportunity we have and probably one of the better in the marketplace. So let's go ahead and put in here, again, we've got a 67-year-old client, and we were going to allocate $135,000. Whoops, let me fill this in first. We were going to allocate $135,000 into the Royal Select, and the reason we did that, it's because the account value and the income account value both get the immediate 8% bonus, and that's going to roll up at 6.75%, so that they can trigger and turn on income in year 2. So you can see here that 1 year later, $135,000, that income account value is now grown to $155,000. Given the client's age and our product, it now allows that they can trigger and turn on an income stream year 2 of the policy. So call it $6,700 of income, annual income in year 2 divided by 12. We can do that on a monthly basis. That means we're able to generate them an additional $558 of lifetime income. They'll never outlive it. They'll never outgrow it. All along the while, the indexed annuity continues to accumulate, give them access to some cash for emergency if they need it. But there is their lifetime income. That, combined with their Social Security income, we've now got them at what? A little over, along with the $1,260 they had, about $1,800 worth of income. And still protection from the market, market participation along the way. So we feel that the fixed indexed annuity really was an ideal scenario for a client just like this. And remember, as long as they keep this policy in force, they are guaranteed that annual income, no matter how old they get, no matter what happens to the account value. It could go to zero, and they still get that annual or monthly income from us for the rest of their life. So let's pivot back over to the screen here. So again, we've allocated $135 to the Royal Select for an income scenario. We could put some of it into a MIGA. We still give them more principal protection. We give them guaranteed growth, and the multi-year guarantee allows an interest withdrawal. So they could get access to some of that cash in the way of interest if they need it. We could find a rate that's comfortable to them, a duration that they like, any and all of it. Now, the one thing I did mention, our policy, the Royal Select allows for income starting year 2. So first year, that means they need to access some additional income. That's why we leave liquid assets. We've got about $83,000 that we left liquid in somewhat liquid form for them, so they can carve out maybe another $5,000 to draw out that $400, $500 a month that they need. So again, they've got plenty of other assets to draw some of that income until we pick it up and start at year 2 with the Royal Select. Of course, again, final expense could be an option if we purchase $10,000 on each of them. That totals about $108 given their current age. And we've kind of made up for that with what we're generating for them above the $400 they mentioned in the way of the fixed index. We generated about $558 for them on a monthly basis starting next year, and they said they need about $400 or so. And as we know with final expense or any life insurance, it's not going to get cheaper the older they get. So we wanted to try and lock in and maybe purchase it for them now. So great time, great place to go ahead and purchase and get some of that final expense coverage in place. Last client, client C, and this just kind of rounds us out. It's a 75, 72-year-old female. They're in pretty good health. Not a lot to speak of here. So again, we kind of went to maybe every scenario you might see, a fairly affluent, kind of middle income to not much real income at all. They've got $42,000 in assets. They've got CD and a savings account. Income is a life-only pension and some Social Security income. So their concerns are income and final expense. You know, what happens if? How are they going to pay for some of those final expense costs? Now, with this client, with this scenario, we always want to try and do as much as we can. Sometimes there's just not much there to do. Annuities have a lot of suitability requirements. And with this client, maybe we could do some things with the CD, give them some guaranteed growth, do a little bit better rate, give them some interest options that they could draw off income. But reality, there's not a lot we're able to really do here in the way of the fixed indexed annuity. Suitability is going to want that we leave enough liquid asset for them in the event of an emergency. So we could maybe take some of these assets allocated to a multi-year guarantee or maybe a portion of it to a fixed indexed annuity to where we tap into an income rider. But we just kind of looked at this scenario and it was more of a final expense need. So with this, you can go into the website and once again back into the calculator section. Here is our final expense calculator. And this allows us to either run scenarios where, you know, we can do, we can solve for a premium amount. Let's say that this client born 2/20 of 1943, and today's effective date is what? Let's just put 19, and calculate our age. Whoops. So, sorry. Okay, so now we've got a 76-year-old client. Oh, I went the wrong way. 75. So either way, our point's kind of the same. So we can put in the coverage amount here. Let's say, you know, they're looking for $8,500 of coverage. They want to pay monthly premium. Down here, it's going to pop it up for us. There's $84.51. Total premium each and every month, $87.76. Print this out. You can leave it with the client, however you want to do it. It also allows us to do premium solves, so we can do much of the same thing. Your client is on a budget. So let's say that they've only got the ability to do, excuse me, they can only afford, let's say, so much a month. So we're going to do the same thing. We're going to go in here and we're going to say that they can afford $50 a month. It's monthly premium. How much can we buy? And you can see here that's about $5,000 of coverage. So it lets us kind of work it backwards into playing with what's reasonable for a client. They can carve out another $50 for him, maybe another, you know, $50 for her, but it lets us kind of hold that, cater it specifically to them, calculate premium. So that's just another look and another way to kind of pull in the calculators, take advantage. We've done all this without having to log into the website, which is fairly convenient. And again, all of these products we've been able to do with a true point of sale decision. So other opportunities, other things you might want to kind of keep in mind as I pivot back here to the PowerPoint. CDs, there's tons of them out there. They're great opportunities. CDs are a great thing, right? But clients most often purchase them, one, for safety, protection, but a lot of times they also pass them just to pass on and leave to a beneficiary. So be sure to ask clients about their CDs. You know, what are they earning? What is it paying? What's your primary intent for it? Our single premium life opportunity, I think, has such potential for everyone out there. Again, it's point of sale decision. You've eliminated what we talked about last week, that fear of underwriting and the process of it and everything with the client. But just looking at this scenario, if we've got a client that's got $50,000 in a CD and they said they just want to leave it to the kids, there is no better product. There's no better potential than something like a single premium life to replace that CD in order to do it. You can look here what that 50,000 accumulates to over the next 5, 10, 30 years, and what we can do in the way of a guaranteed immediate tax-free death benefit to the kids, the grandkids, whoever it is, right out of the gate. It's almost $114,000. And again, client still has access to those funds if they want it. It's got a return of premium feature. It's got nursing home, terminal illness, all those things should the client still need to be able to access it. Policy loans, it's still fairly flexible for them. But again, the power of the life insurance, the tax-free death benefit, that's their primary intent for it, as most CDs are. Single premium life is a much better alternative and kind of place to look towards it. And that is also a point of sale decision. So some other areas where Oxford Life is hopefully going to stand out for you. We do 48-hour issue on final expense. Any of our policies we do once it's been funded. We pay commissions on a daily basis. We have e-apps, mobile apps, calculators for you that we just looked at, that InstaWrite process. It's an immediate approval, point of sale decision, whether you want to do it through a phone call or through the website. Really ease of issue. And then again, a competitive and complete line of senior life insurance products. Contract with us today. Please reach back out to Messer. Tell them you want to get on board with Oxford Life if you're not already. But again, life, annuity, and MedSup opportunities all available, just one contract. Some of the most competitive pricing in the marketplace today. And again, we went through some of those scenarios and how they might fit you and your clients. I hope they're helpful. But we're certainly available here to help for any of those kind of conversations, how our product might fit. So please contact us or contact Messer for more specifics on the product or how we might help out. So with that, Mark, I'll flip it back over to you. And thank you as always, and thanks for the opportunity.
Well, once again, Chad, thank you very much for a very informative presentation. All of us out there have, I hope, had our eyes opened and recognized all types of options that you have when you're working with your senior market. I think all of us go into a home, our primary objective is to get that MAPD plan in effect, or that supplement and Part D program. And we know that there's something else there, but we're just a little bit hesitant. And how do we approach that client on the funds that they have available? And I think some of that comes just from our fear that we might not do the right thing for the client. So again, Chad has given you some very easy examples of how to approach that situation. And of course, the easiest one is, what type of funds do they have available in the banking industry that certainly aren't going to give them the kind of returns that you're going to have available to them as options to choose from. I also think it's important that you recognize the fact that there is what's called suitability. If annuities are something new to you, the whole premise there is that unfortunately in the past there have been times when insurance agents or others have gone in and taken advantage of seniors and the funds that they do have available that are so important for them for their lifestyle. And because of those problems, of course, the government's had to step in and say, hey, we got to be having a little bit more control and make sure that people aren't being taken advantage of. And that's where your suitability exists. So it doesn't matter whether you're working with Oxford or any other carrier out there that provides an annuity product, you're going to have to meet the standards provided for suitability, meaning that, again, you're not going to attach funds that they may need for basic living expenses. And they have guidelines and they'll determine that, and you'll have to fill it in on the actual application. And unless you're paying attention to it or getting some advice in advance, you could have the whole contract of that annuity turned down. Remember too that an annuity is a life insurance product. So again, first and foremost, you obviously have to have your life insurance license and be appointed with the company that you're going to write the business through. But also knowing that you've got that license and it's something it's your livelihood, that you want to have particular care and caution in how you approach this. So again, that's where you have the benefit to come back to us at Messer to rely upon our producer support department, or in cases where necessary, where we need to make that call, we will, and get the proper advice from Oxford, all the way up to and including their legal department, which they make available to us so that we don't make a mistake when we're entering into that agreement with the client. So with all of that in mind, again today, Chad, I thank you. You brought us some great information, some great options. And I think also, as Chad brought to your attention, you know, get that appointment with Oxford completed so that when that time comes in advance, you're prepared. Can you go ahead and get started? Actually, you can't, because with final expense products and annuities, you need to have that contract. There's also a little bit of training involved in making sure that you're up to speed on the products that you're offered. And that's going to be, again, whether it's with Oxford or any other company that's providing an annuity product to you, you're going to have to do a little bit of training to just verify that you're good to go when you present that information to your client. Let's take a look and see. I haven't even opened the door yet to see if we have some questions out there. Unfortunately, we don't have any questions, so either one or two things. Chad, you've done an excellent job in presenting it, and it's understandable, which I think certainly is the case. Or number two, again, you're a little hesitant as an audience as to what you're going to do with the information you've now had presented to you. Bear in mind that Messer will have this recording up on the Messer Learning Center on our website, and you'll have access to that. And that'll be available to you whether you are or are not a licensed and appointed agent with Messer. So hopefully you are. But again, what Messer's trying to do is help people become good agents. And we hope that by providing you the tools like this presentation today, that you feel you want to become more involved with Messer and with other products. We have a great department of personnel here that are our quote unquote marketers, the people that will work with you directly and help you find out which companies are a good fit for your needs, help you through the appointment process, and be there to answer questions in the direction that you need to take. And basically, what I'm getting into today is, you might have seen if you received the email blast, we wanted to introduce you to the all-in program that's going to be offered here at Messer Financial. And basically, all in means that we will commit to you all in if you in turn will commit to us all in. All in means that you bring your contracts to us. And if you are able to do that and become an all-in Messer agent, I want you to know about some of the benefits that you could receive or will receive once you make that commitment. First of all, you're going to have the opportunity to be entitled to get your E&O insurance at no cost. That's going to cover your life, your health, your advantage plans, your annuities, your disability business, your long-term care, any products that we offer that you sell through us under our E&O, you will be protected. And also importantly, our E&O is individual. It's not that you're in a group of people where there's a pool of money, so that if errors are made and the pool dwindles and you happen to be the last one in the pool to be looking to get some monies and there's none left, you're holding the bag. So again, these are all individual accounts. As we progress again in our business, and all of us know how important it is to have leads, one of the sources that agents find to behoove them is having a website. Well, how would you like to have a free client website? That's one of the benefits of the all-in program. How about receiving the business cards that lets you stand out a little bit more because, again, as an independent agent, just going out sometimes and talking to people for the first time, it's good to have knowledge of a support network, to know that you're with a company, to inform them that you're with a company that has over 20,000 agents nationwide. That's some pretty strong talk. So with those business cards, you go in and have that done. Also, once you become one of our all-in agents, this is pretty important right now at this time of year, we're going to provide you with a free AHIP ability. So save that extra $175, $125, whatever the fee would have been if you didn't have that benefit, and move that over into a benefit with Messer that we want to provide to you. We're also going to help you and attach to you additional leads to start off your AEP system. And those are going to be valued at like 500 bucks. We'll have production leads available to you with time as well as you do produce. And then there's going to be other additional benefits. I'm going to just touch on them real briefly because we have some great software from the MyMFG programming. And we also have the MyMFG Office in the Box program. And what that's going to be is giving you as an agent an ability to have a background office software that's going to do pop-up work on your clients. It's going to do video calling for you, or video calling with the screening regarding the recording of what's done, voicemails to your email, a whole bunch of other things. And also, here's one you're not going to find anywhere out there, ladies and gentlemen, as an agent, as an independent person. How sweet it would be if you could know you could get your group health insurance provided by the likes of a company like Messer. These are available to you if you become part of our top producer division. And again, I can only say to you, for the amount of time I've been in the business myself, some of the benefits you're looking at here, you only get if you're captive. And we're not asking you to be captive with one product and one line to sell. We're saying to you, you've got lines, any line you want to sell, any product you want to sell. Bring that contract and all those contracts to us for those lines, and we want to step up to the plate and bring additional benefits to you. How will you learn more about that? What we would like you to do is to obviously call in to us at Messer Financial. Talk to one of our marketing representatives. Talk to someone in producer support. If you're not currently, again, contracted with us, begin to get familiar with what we can do. We're all here to help you, myself included. Messer Financial's phone number, the 800-568-9649. And our extensions, if you go to our website, you'll find all of us listed there under the structure of the staff. My personal extension is 713. I'm here to take your calls just as well. We're all here to help you. So again, I want to thank you for being a part of this today. I hope that you've again opened your eyes to some opportunities that you may have been letting get away. And again, I hope most importantly that we're giving you a reason to do business with us. Thank you again. Chad, thank you very much for everything today to get us to this point.
Thanks, Mark.
And everyone have a great week, and the beginning of summer is soon, so enjoy your summer. Talk to you soon. Bye for now.